Good evening, everyone. Welcome back. How are you all? Are we doing good? Preparing well for the upcoming exams, everyone. Good evening once again, everyone. Very good evening. I hope you are all doing good right now. I can see people are online already. Yep. Good evening, everyone. Okay, so I welcome you back again to this session of uh, ICAI, which we are going to learn the subject of financial management. We have started with the subject and covered quite a few topics. Our topic for today is, as you can see in the screen, it is capital structure. Okay. So in module, you'll find there are two chapters on this. One is about capital structure problem, and another is the capital structure theory. So I'm going to divide today's session into two sessions, rather two sub-sessions. Uh, the first session we are going to learn about capital structure problems, and then we will go ahead in the second session to discuss the various capital structure theories. Okay, so let's get started, guys, without wasting much of our time. Let's get started. Capital structure. Okay, let's take an example to understand what we are really talking of. Let's say there are, no, we are considering three companies. Take, one of them maybe let's say EPC Limited. The other is XYZ Limited, and we have PQR Limited. Okay, three companies. Let's look at the capital structure. Now, when we say capital structure, what do we mean by it? Capital structure means we're talking of what is the quantum of various sources of funds that it has got. And what's the quantum of equity shares? What's the quantum of debt? What's the quantum of preference shares? What is the quantum of retained earnings that the company has got, right? So as far as these three companies are concerned, let me just write down their capital structure. So equity share capital, equity share capital. Uh, let's say the first company, or let me first write down all the sources first, and then we look into the numbers. Capital structure comprised of equity share capital, their retained earnings, and then we have like say 8% debentures and maybe 10% preference share capital. Okay, so and then we'll say what's our total capital employed. So first company, ABC Limited, it is fully equity. Okay, it's fully equity. It comprises of no sort of debt or preference shares. So fully equity, let's say it has got a share capital of 10 lakh, retained earnings of 5 lakh. Of course, are having a face value of 10 rupees. And preference share capital is having a face value of 100. Okay. And debentures also, let's simply take it as not if they are of face value 100 again. So the first company that we say, ABC Limited, is a fully equity company. Over here, what we observe is the total capital employed is 15 lakh. So investment in the business is 15 lakh. Then XYZ Limited, there it has got a equity share capital of 5 lakh, reserves of 3 lakh, and debentures amount to 7 lakh. So if you take a total of it, that's 15 lakh again. For PQR Limited, um, it has got 5 lakh of equity shares, 3 lakh of retained earnings, and 3 lakh of debentures, and 4 lakh of preference shares. So that gives us a total capital employed figure to be 15 lakh. That's same 15 lakh for all the three companies. Now, if I ask you that all the three companies has got the same amount of earnings before interest and tax. All the three companies, ABC, XYZ, and PQR, are having the equal amount of earnings before interest and tax. Okay. So if the earnings before interest and tax is equal, let us say it works out to be earnings before interest and taxes 20 lakhs, no, not 20 lakhs, sorry. Let me take it as 2 lakh 50,000. All the three companies are having same amount of earnings before interest and tax. Now, if I ask you, just give me a wild guess. Uh, Out of these three companies, which one do you think would be performing well? One second. Let me just. Uh, I think the voice should be fine now. It should be proper. Just change the mic. Is it proper, guys? Now is it okay? Now the voice is fine. Okay, is it fine? Okay. So now tell me, we've got three companies: ABC, XYZ, and the PQR. Capital structure is different, but I'm saying that all the three companies, ABC, XYZ, and PQR, are having earnings before interest and tax equal. So my question to you is, just give me a random guess. If you have logic, that's well and good. Just can you tell me, out of these three companies, which one would be performing really good, or performance-wise, which of these three companies are beneficial for the equity share? Which of these three companies are good, are providing rather good return to its equity shareholders? Can anyone tell me? Just try to think some logically, and maybe then you can answer it, or you can just make a random guess also based on your gut feeling. Which of these three companies do you think would be performing uh, better for its equity shareholders, or would be providing uh, you know higher rate of return for its shareholders, for its equity shareholders to be specific? Tell me, guys, which company would you think be providing better return for the equity shareholders? Yeah, guys, XYZ, or is it ABC? XYZ or ABC? Okay, some of you are saying ABC, some of you are saying XYZ. Students here who are in the Zoom meeting can also participate. Tell me, which of these three companies do you think would be performing better for its equity shareholders? Which of companies would be providing higher rate of return for its equity shareholders? Okay, so let us do one thing. Let's prepare the entire income statement. So we'll subtract from here the interest. Right? So you get profit before tax. Then you will subtract tax That will give you profit after tax, right? Then from this, we are going to subtract preference dividend, which will give you net profit for equity shareholders, right? So, if you prepare this entire income statement, let's just try to observe what's happening. In the first case, there's no interest because there's no debt at all. In case of second company, there is a debt of 7 lakh on which interest at the rate of 8% is paid. And same goes for even the third company, PQR. We get a profit before tax by subtracting the interest from EBIT. So EBIT minus interest, get this lakh 50, 1 lakh 94, and 2 lakh 26,000. From that, we are going to reduce the tax figures. So let us assume the tax to be at the rate of 30%. This into 30%. And profit after tax will be PBT minus tax. Okay. From that, we are going to subtract the preference dividend, which is at the rate of 10%, right? And then the net profit for equity shareholders can be obtained as PAT minus preference dividend. Okay. Now, looking at these numbers of net profit for equity shareholders, looking at these numbers for net profit for the equity shareholders, can you tell me which company has provided better return for its equity shareholders? Can we really decide whether the company has given good return or not as compared to the other companies by looking at net profit for equity shareholders? Of course not. We can't do that, right? Because in case of first company, share capital and the retained earnings, which is the owned funds, is of 15 lakh. Whereas for XYZ and for PQR, the retained earnings and the share capital are different. So when we have to decide which of these companies are providing better return to its shareholders, one way to compute that is we will be computing something called as earnings per share. Now, how do we get the earnings per share? Subtract, or rather, we are going to divide this net profit for equity shareholders with number of equity shares. So we get earnings per share. So in case of the first company, number of shares is 1 lakh. For second company, it is 50,000, and for third company, it is again 50,000. So what will be the EPS? Can you compute the EPS? Yes. Are you able to get the EPS? The first case, you have the EPS as 1,75,000 divided by 1 lakh. Then it is 1.75, 2.716, and 2.364. Now tell me, based on EPS, which of these three companies are providing a good return for its shareholders? Which of these three companies are providing good returns to its equity shareholders? Is it ABC, XYZ, or PQR? Of course, it is the company PQR, which is providing good return to its shareholders. because, sorry, not people, right? The company XYZ, because there we observe that we have got the highest EP or the highest EPs, right? Now, what are the type of questions that we observe? Uh, may ask you, tell us which of the three plans should be selected. Like instead of naming them as three companies, XYZ and PQR, you can simply say, tell us that, let's say, have plan one and two and plan three. There have got three plans of raising money. So out of these three plans, which plan is the most beneficial one? Want to check out of these three plans, which plan is the most beneficial one? Of course, our solution, our conclusion will be plan two should be chosen. Like if I want to start a new venture and I need a 15 lakhs of investment, how should I raise the money? Should I be raising it fully by way of equity or by way of debt or by way of equity debt and preference share? I will be calculating the earnings per share. And then based on earnings per share, I'll have to choose the appropriate. But if the question also gives the information about the price to earning ratio, if the question gives the information about PE ratio, right? So we have to get the market price per share based on this EPS and PE. The EPS is given and also P ratio, if EPS is something what we computed, and if P ratio is also given, let us say P ratio is 7, let's say this is 10, and 8, and this is 7. You can get the market price per share as EPS into P ratio. And then based on this, you have to choose the appropriate plan wherever you have the highest market or highest market price. You can see that this market price per share is highest for the plan. Are we getting it, guys? How do we choose an appropriate financing plan? Everyone, is it clear? Is it clear? How are we going to choose the financing plan, guys? So I need to compute the amount of EPS, and after that, I have to go for multiplying the EPS with P ratio to arrive at the market price per share. Now, let me just place one question. Let's take one more case, and you are going to determine uh, whether which plan should be chosen rather. Say existing capital, or let me just say plan one and plan number three. Towards equity share capital serves 10% debenture and 11% preference share capital. Plan one, you are going to have 15 lakh equity share capital, 10 lakh reserves. Plan two, there is 5 lakh equity share capital, 5 lakh of reserves. Maybe let's venture is 10 lakh, equity share capital over here 5 lakh, reserves of 10 lakh, uh, and preference share capital, right? And this is also 5. equity share capital having a face value of 10. You can observe that sum of all the capital structure, total capital employed is 25 lakh. Now, my question is, let's say EVIT works out to be uh, close to 2 lakh. Whichever plan you choose, the earnings before interest and tax is 2 lakh. I want you to tell me which of these three plans is going to be suitable, or which plan of fundraising should be uh, plan of fundraising should be adhered by the company. Which plan should be chosen? Expected EVIT is 2 lakh on this one. Come on, let's work it out. Just maybe a couple of minutes. Just roughly work out and check what are the numbers for EPS, and then let me know which of these three plans should be chosen. Able to get the EPS, bring it out. Compute the EPS, and then let me know which of the plans are the best suited for this activity. We need to first subtract the interest, that will be profit before tax, that we need to subtract the tax rate, which you can safely assume it as the given case, percent, the PAT, that we need to subtract the preference dividend, and have net profit for equity share. Interest will be debentures into 10%. EBT is EAT minus 0 or EAT minus interest. Tax, you just need to subtract it at the rate of 30%. Then get the PAT figures, the share capital into 11%. Net profit for equity share. 140, 70,000 and 50,000. These are the net profit for equity shareholders. We need to divide it by number of equity shares, number of equity shares capital divided by 10, number of equity shares, and then finally we have the EPS. What we observe is EPS is 0.933, 1.4, and 1. Just check, guys. Are we getting these EPS numbers, everyone? Yes. Verify it roughly quick. Getting these EPS numbers. Yes. What should be your decision? How are you going to raise the funds? Which plan are you going to choose over here? Is it plan one, two, or three? Which plan are we going to choose, guys? Is it going to be plan one, plan two, or plan three? How are we going to raise this required 25 lakhs for the business? Plan two, right? Because here we have this as highest EPS. Plan two, correct? Okay, so that's what we are election of capital structure is concerned. Capital structure can be selected on the basis of the highest EPS. And if the question gives you information about the P ratio, then you should be choosing the plan where the market price is highest. Okay. Now, just give you a case to solve. Let's say we have current EBIT as 5 lakh 20,000 and we have current capital structure. Current capital structure comprised of equity share capital, reserves, and debentures. Equity share capital is, let's say, 8 lakh, and reserves are 12 lakh. He has got a debenture, let's say, to the tune of 10 lakh. So what we observe, total capital employed as of now is 30 lakh. Now the company is suppose looking for expansion. It needs some additional money, right? So say funds required for expansion. So moving into some new project and it needs some additional money. Funds required for expansion is say it needs 4 lakh for expansion purpose. One thing I forgot over here, existing P ratio or existing price to earning ratio is 10 as of now. The new funds that are required is 4 lakh. Now the company is contemplating from where should we raise this money? From where should we raise this money? So for this 4 lakh, first option that we have for this 4 lakh, first option that we have is um, funds required for expansion is 4 lakh. So first option is to raise it as by way of equity shares issue. First option is if you issue new equity at the rate of um, let's say 12 each. And of course, the face value that we have over here is 10. Okay. First option is to raise this entire 4 lakh by way of equity shares. So we're going to issue equity shares at the rate of 16 each. Second option is no debentures. Second is by issuing new debenture at the rate of 100 each, or wherein your rate of interest is let's say 11%, and these debentures are costing you 10%. Debentures are costing you 10%, and new debentures that you're going to issue are going to cost 11%. So now my question is, no, out of my question is, out of these two options, which option should be chosen? If I say that this additional 4 lakh is going to provide additional EBIT of, suppose, 1 lakh. Additional EBIT is going to provide you additional funds that are investing 4 lakh will give you an additional EBIT of, suppose, 1 lakh. So what are the financing plans that we are looking at right now? We have got two financing plans. We've got two financing plans wherein equity share capital will have those. So two financing plan. One is raise this additional funds required by issuing equity shares at rupees 16 each, and the second is to issue new debentures. So under first plan, if you're going to issue new equity shares, what will be the count of equity shares? What will be the count of equity shares? Of course, there's already 8 lakh worth of equity share capital, and you're going to raise additional 4 lakh. Can you tell me what will be the share capital figure? The share capital figure over share capital figure will be simply, this 8 lakh plus 4 lakh is going to be raised by way of equity shares, but each is going to be issued at the rate of 16. But the face value is 10. So the new equity share capital will be 10 lakh 50,000. Whereas reserves is going to be 12 lakh plus again 4 lakh raised by 16 at the rate of 16 into 6 rupees being the premium. The debentures count remain the same. So if you take a sum total, that's 34 lakh. Additionally, we are seeing that 30 lakh is the total capital employed. 4 lakh is something that we have already raised. 4 lakh is something that we are going to raise by way of equity shares. That becomes the total capital employed of 34 lakh. But here, one thing to be noted is, but how will you compute the number of equity shares additionally that are issued? That's simply 4 lakh. You divide it by 16, which is the price per share at which you are issuing, and then multiply it by 10 at the face value. And same thing you do it for reserves, wherein you are going to multiply it by 6 to arrive at the reserves. Okay. Then we have debentures remaining the same, which is now second plan In the second plan, your equity share capital and reserves are remaining same because you are issuing new type of debentures. Original debentures remain the same. Now you have additional debentures worth 4 lakh coming in, wherein the debentures going to be issued at 11%. That's 34 lakh. Okay. Now, can you tell me what will be the expected EBIT? What will be the expected EBIT? Well, the expected EBIT is, whatever EBIT that we had already, 5 lakh 20,000. On that, you will add a additional EBIT of 1. So expected EBIT will go up to be 6 lakh 20,000, irrespective of whichever plan you use to raise the money. Sometimes questions can be also based on that there is an existing capital structure and new funds are going to be issued. That is going to be computed in this way. Get the total capital employed same as 34. Okay. So now my question is, we have got this capital structure. We have got the expected EBIT also 6 lakh 20,000. Now, the next stage is what you are supposed to be doing right now. Compute it till all the levels. Okay, so you're going to reduce the interest. So you get profit before tax. From that, you will reduce tax, which will give you profit after tax. From that, you will reduce the preference dividend. That's going to give you net profit for equity shareholders. Okay. And one more thing I would like to inform you over here, P ratio, price to earning ratio. Let us say for the first plan, the price to earning ratio will remain same as it was earlier. If you're going for the second plan, which you're going to take more debt, then your price to earning ratio is going to drop, let's say 9. So now I want you guys to compute which plan should be chosen by this company, because you need to first divide it by number of equity shares to get the EPS, and then you also have to get the market price per share. Just have to complete this and give me the final figure of market price per share. So till that time, I'll just answer Kiran. Kiran, you're asking, did not understand the calculation of reserve. Okay. Kiran, reserve calculation is simple. Originally, you had a reserve of 12 lakh, right? Or else I'll do it like this for you. Additional funds required are 4 lakh, right? So can you tell me what will be the number of shares that you're going to issue? Can I say it will be 4 lakh divided by 16, because each share is having a cost of 16. So the number of shares that you're going to issue is 4 lakh divided by 16, which is 25,000. Right? Now this 25,000, you can say equity share capital will be 25,000 into 10 rupees. Additional equity share capital you will have like 50,000. But since we are issuing the shares at a premium, that is, we are going to issuing the shares at a price of 16. This is the 25,000. 6 is the amount of reserve, which is 1 lakh 15. Okay. That 1 lakh 50,000 gets added to the reserve. So originally it is 12 lakhs. So on that you have an additional 1 lakh 50,000. Clear, Bala? Not clear, Kiran? What is sorry? Apologies. The reserve calculation not clear, Kiran? Well, others, I'm waiting for your answer. I'm waiting for you to give me the market price per share numbers. Complete this statement and give me the market price. Given the market price per share is, you can just work it out quickly. Manner also. Give me the market price per share is. Okay. You just put the things around. Interest is it 1 lakh and 1 lakh 44. You get the profit before tax. And on this, you have a tax of, let's say, 30%. Then we get a profit after tax preference dividend. Then there's no preference dividend over here. Whatever is our PAT, that itself is the net profit for shareholder. Then we say number of equity shares, basically equity share capital divided by 10. EPS is EPS is net profit for equity shareholder divided by number of equity shares multiplied by P. Get the market price per share. Market price per share is simply just need to calculate the EPS and then multiply it with the P, price to earning. Price to earning is 10 and 9. So you can just multiply the EPS with the respective P. You get the market price per share. So now can you tell me which plan should we choose? Select uh, or which plan should we choose to raise the funding? Should be plan two, right? Of course, it has to be plan two because there get the highest value for your shares. Then you can simply compute the market price by multiplying earnings per share with the P ratio. Did you all get these numbers? Market price numbers. Did you all get the numbers of market price? Everyone? Yep. Okay. Perfect. So now, as we have seen, how do we choose a respective financing plan for the purpose of raising money? Our thumb rule is we'll choose a plan which gives me the highest yes. And if market price per share is given, then we should choose a plan which gives you the highest market price per share. Okay, guys. Okay. Now let us go for next concept. Concept that we have in capital structure is we have to compute something called as financial break-even point. Financial break-even point. Gunjan Kumar, if only EPS is given and P is not given, you have to stop your calculation at EPS itself. You have to go to MPS calculation only if P is given. If you have price to earning ratio given, then only you have to go for calculating the MPS. Otherwise, you have to take the decision based on this. Okay. Now, let's go for the new concept called as financial break-even point. Financial break-even point. Have you heard of this term break-even point, everyone? Have you heard of this term break-even point? Yes or no? Have you heard of this break-even point? Yeah, it's a no profit, no loss situation, right? So break-even point, the result of break-even point is no profit, no loss. The result of the break-even point is no profit, no loss. So then just tell me, uh, what is that break-even number? Can I say we say that at this particular level of sales, my situation is no profit, no loss. So normally when we say only break-even point, say only break-even point, we write this as the only break-even point means the level of sales at which NPV, sorry, not at which profit is equal to loss is equal to zero. It's that level of sales at which there's no profit, no loss, or I can say it is that level of sales at which all your cost is recovered by the revenue. Similarly, when we say financial break-even point, what do we mean? Financial break-even point simply means, guys, it is that level of EBIT at which earnings per share is equal to zero. Financial break-even point is where earnings per share is zero. Okay. So basically, we have to do some sort of backward calculation. Now, can definitely compute it in the form of backward calculation. That let me just say one of the plans, maybe, yeah, let us just consider example that we have taken, maybe this one, and based on that, we go around for computing the EBIT. So here we want the EBIT, the, the we want the EBIT where the earnings per share is going to be seen. Write down this entire income statement, entire income statement. Just wrote it down. Okay, so I get the EPS figures. This color context. Now, our idea over here is to get these EPS figures. Our idea is to get these EPS figures zero. Our idea is to get the EPS figures zero. So you want to know at what level of EBIT, what should be this EBIT so that our EPS is zero. How can we simply do that? We can essentially calculate it in a backward calculation. You can do it in the form of backward calculation. Let's first do by backward calculation, then I'll also give you a formula for it. So we want the EPS to be zero, right? We want the EPS to be zero. EPS has to be zero. Then what should be the net profit for equity shareholder? Can I say that also definitely has to be zero? Net profit also has to be zero. Preference dividend is something that's not going to change because that's going to remain same as it is. Okay, but yes, if I want my preference, if I want my net profit for equity shareholders to be zero, then the PAT, backward calculation that we're doing, then the PAT has to be zero in the first case. The second case also it has to be zero. And in the last case, can you tell me what should be the PAT? Can you tell me what should be the PAT, guys? Very good, right? Yeah. Can you tell me what should be the PAT if I want my net profit for equity shareholders to be zero and my preference dividend is 55,000? The PAT has to be exactly equal to my preference dividend because only if I'm earning sufficient enough to pay the preference dividend, that's what going to be, beneficial. Right? So 55,000. Of course, in this case, since your PAT is zero, tax also has to be zero. Here also it's zero. Then this has to be like, cross multiplication wherein you say PBT is 100, so tax is 30, so this should be 70, and you do the cross multiplication. So by doing that, we'll say that PBT is 100 multiplied by 55,000 divided by 70,000. That's the PBT. And tax is, of course, this multiplied by 30%. Okay, so PBT is 78,571 and tax is 23,571. So my interest amount is still over here is going to remain same because here we don't have no preference dividend. So since your net profit for equity shareholders is supposed to be zero, PAT also has to be zero, even the PBT needs to be zero. So if I compute the backward, what I observe is the amount of you know, it's like 1,28,571 is the break-even point. So if you take EBIT as 1,28,571, and if you just calculate till the end, EPS, find that EPS works out to be zero. So our break-even point, these three numbers that we computed, are nothing but the financial break-even points. All three of them are financial break-even point. This can be computed by doing the backward calculation as we did over here, or else we have got the formula also. Financial break-even point formula is simply interest plus preference dividend divided by 1 minus. We just verify this formula. See, interest, well, there's no interest, there's no preference dividend. We divide it by 1 minus point. So if I apply this formula, you see that this works out to be exactly the same number. EIT is no the financial break-even point 0 lakh and 1,28,571. Did we get it correct? Financial break-even point. Just remember this simple formula. Did not do uh, say, not do the reverse calculation again and again. Just use this formula to get the financial break-even point now. Are we clear with this financial break-even point, everyone? We're good with this financial break-even point? Yes. Okay. Now, what is the significance of this financial break-even point? What's the significance of this financial break-even point? Well, the significance stands as this. Let me just ask you. Look at this financial break-even points and tell me which of these three company, which of these three plans have got the highest risk and which of the three plans have got a lowest risk. Which of these three plans have high risk and which of these three plans have low risk? Yes. What do you feel? Which of these three plans are more risky? Of course, it is third plan which is more risky. Is why do we say so? Because in the first case, uh, in case of the first plan, so break-even point is zero. Break-even point is zero means um, shareholders have returns from uh, equity shareholders have returns if EBIT exceeds zero. Even if your EBIT is exceeding zero, EPS will be positive. Or I can say EPS is positive, okay, if your EBIT is greater than zero. Whereas in the second case, your EPS will be positive only if your EBIT is greater than 1 lakh. And that is even more riskier if you go for the third plan, Because in the third plan, your EPS is going to be positive if your EBIT is more than 1.28. EPS is going to be positive. EBIT is more than 1.28. Company need to push a lot to enter into that profitable area. To enter into that profitable area, in the third plan, company need to not to enter the profitable area. Therefore, we say this plan is going to be more risky. So remember the thumb rule for financial break-even point. What is the use of financial break-even point is higher financial break-even point indicates higher financial risk. Just keep this in mind. That's the most useful application of financial break-even point, wherein we say the financial plan with higher break-even point is going to be having a higher financial risk. Perfect. Are we good? Everyone, please confirm we are clear with the financial break-even point concept. Then only I can go ahead with the next concept in the capital structure problem part. Tell me, guys. Are you clear with this? Financial break-even point. Is the concept very clear? Okay, great. Now let's go for the next concept that we have in capital structure, which is called as the indifference point or financial indifference point. Now, financial indifference point. What do you mean by this term, financial indifference point? Have you heard of this indifference point anytime else, anywhere? Ever heard of this term, indifference point? This term, indifference point. No? Okay. Anyways, let's simply do it. Indifference point. The concept is pretty simple. We say it is that level of EBIT at which financial indifference point is that level of EBIT at which EPS of both plans are equal. In that level of EBIT, EPS of both plans are equal. So we are going to consider two plans, two financing plans, and we want to check what will be the level of EBIT at which EPS of both plans are equal. Now let me just show it to you with the help of a example. Let me consider the first example that we did. Take plan 2 and 3. So anyways, take it up. EPS only. So here we had this numbers, rest, okay, and reference dividend is this is what we have already done, right? So we got the capital and we also got the income statement ready for us.
Now the point is, we want to change this EBIT because this EBIT is common for both. I want to check at what level of EBIT yes are going to be also seen. Because as of now, we find that EPS of the uh, third plan is lower. This is higher. If you want to write an EBIT wherein this both the numbers should be seen, let me just do a bit of financial modeling part of thing like over here. Suppose if I make this as 2 lakh, same over here. What we observe is this is higher, right? This is a higher part. Now let me just do one small change to understand this concept. Uh, just remove this and or maybe back, and we have an equity share capital of 7. Take it as ventures of take it as 5. Okay. So now at the EBIT of 2 lakh, you observe that EPS for the second plan is 2.06 and this is 2. Now as I change the EBIT, let's say I make it as 3 lakh, you see that this is again on the higher side. If I take a lower side EBIT, say just a lakh, then we observe that this is having a higher EPS. So in some set of EBIT, you find that the first plan is having a higher EPS, and in some set of EBIT, you have a third plan which is having a higher EPS. So let us do one thing. Uh, Let me say that let X be the indifference point. Let X be the indifference. So if X is the indifference point, and I want to compute EPS for plan 2, EPS for plan 2, we can say X minus, we will subtract the interest. Once you subtract interest from X, that becomes a profit, what is it, before tax. From that, I'm going to uh, subtract the tax. So we'll say into 1 minus to make it after tax figure. From that, we'll further reduce preference dividend and then divide it by number of equity shares of plan 2. Let me just enter the numbers. So this is X minus interest in the first plan, it is 56,000 into 1 minus tax rate of 30% minus preference dividend not applicable in this. Then we divide it by number of equity shares, which is 50,000. Then we look at EPS of plan 3. Also on the similar lines. On the similar lines, we say X minus 40,000 into 1 minus 0.3 minus we have a preference dividend of 40,000. Interest is also 40,000 and preference dividend is also 3,000. Then divided by number of equity shares 30. We can simply solve these two equations now. We can simply solve these two and arrive at the value of X. So let's try to solve them. We can solve them as remove this zeros and We say x minus 56,000 into zero point 0.7 divided by 5 is equal to x minus 50,000 into zero point 0.7 uh, less 40,000 divided by 3. So let's just open the brackets and do the cross multiplication. 0.7x minus 56,000 into zero point 0.7 is 3900 on 5. That's equal to again 0.7x minus 30,000 into zero point 0.7, which is 28,000 minus 40,000 divided by 3. Let's do the cross multiplication. 0.1x minus 39,200 which is 1,70,600 equal to zero point 0.7 into 5 is 3.5x minus 28,000 and 40,000, that's 68,000 multiplied by 5, that's 3,40,000. Take x values on one side, 3.5 minus 2.1 is 1.4x, and rest all numbers on the other side. 3,40,000 minus 1,17,600, 2,22,400, and if you divide it by 1.4, get x value as 1,58,857 as the x value. Let's just verify what happens if I take the EBIT level as the one that we computed right. I take the EBIT level as 1,58,857. You can simply observe what's happening to the EPS. You can observe that the EPS is remaining same if we take the EBIT as 1,58,857. So at this EBIT level of 1,58,857, that the EPS is same for both the plans, which is 1.4, right? And therefore, we say that this EBIT level is what is an indifference point in which both the plans are equally attractive because both of them are providing me an EPS of 1.44. Okay, but the most important application of this is what would happen if instead of 158,857, I take a higher number. If I take, let's say, 2 lakh, we observe that the second or this third plan is more better. Now, when I say third plan, it has got to be a more, high risk because there's a lot of borrowed funds over here. In some sort of, external funds are to a larger extent because here you have in plan 2, 7 lakh is the borrowed money, whereas over here 5 lakh, 4 lakh, 9 lakh is something which you're getting from the persons who are asking for fixed rate of. So, conclusion is if your EBIT is greater than indifference point, right? If your EBIT is greater than indifference point, can I say this plan is preferable? On the other hand, if your EBIT is less than indifference point, what you will observe is less risky plan is preferable. So if your EBIT is 2 lakh, we say that the plan 3 is preferable. Same way, if I take it less than that, suppose we take the EBIT as 1 lakh. Now you observe that plan 2 is better, which is having less risk. So the conclusion is same. If you take the EBIT as our difference point, which is 1.7, then at that point, both plans are same. But if your EBIT, if your expected EBIT is something more than 158,857, then we observe that the risky plan is preferable. And if it is lesser than that, then we say less risky plan is preferable. Is this indifference point concept clear, everyone? Clear with the indifference point concept, which is about identifying which plan should be chosen over what range of clear. This point, the concepts clear, guys. First, we had the break-even point, and then we have this indifference point, wherein we are looking for EBIT level at which your EPS, earnings per share, is just one and the same. Is this clear, everyone? Concept is clear to everyone. Okay, so with that, we are through with the first part, which is capital structure problems part. Uh, and next is we have to do the capital structure theories, which will take it up, the second part of our session. So someone has meaning of indifference point. Meaning of indifference point. Indifference point over here you can observe uh, at 158, 857. At 158, 857, your EPS is remaining same. So we say this is our indifference point. If this is something else, like one instead of 158, 857, if you have something else, then the EPS numbers are going to change. Indifference point is basically the level of EBIT at which plans are equally attractive. There's no supremacy in the uh, choice of plan. Like as I said, if you're taking your expected EBIT, if it is more than this figure, 158, additional like a two and a half or anything more than that, then you will go for the risky plan. If it is less than this EBIT level, let's say your expected level of EBIT is 1 lakh, then the less risky plan will be preferred. Okay, so let's take a short break, guys. Let's take a break of 10 minutes. Then post that, we can go ahead with the capital structure theory part. Okay, so let's take a break, guys. Welcome back after the break, guys. Before the break, we completed the capital structure problems part, and the concepts, and also some of the questions. Now it's time for us to go for the next part of the chapter, which is about the capital structure theory. So what is this capital structure theory chapter all about? First up, we're talking of the capital structure theory. In this chapter, we are in this particular section of the chapter, we're going to be going through the debate that is ongoing between set of financial economists. Now, what is the debate? It's a question. Uh, well, they say that will capital structure, which is debt equity mix rather, right? Capital structure, which is debt equity mix, affect the value of business. The question is, will capital structure, which is a debt equity mix, affect the value of a business? So let's go in detail. It talks about, will taking debt for investment in business affect its value? Or you can even more get it in detail, wherein we are going to say that suppose there are two identical, we say if two identical companies, or you can call it as firms also, if two identical companies or firms uh, are having different capital structure, that is, we say two identical companies in as far as the operating part is concerned. As far as the operating part is concerned, we say both of the companies are identical. But if we want to check whether there is any effect of the capital structure, we say if there are two identical companies which are having different capital structure, that is, uh, one is, let's say, fully equity, and other is, you cannot say other is fully debt, because other is going to be, equity and debt funded. Then will the value of both companies, will the value of both companies be same, or is it going to be different? Right? So that's the basic question that we are looking to answer. Will capital structure affect the value of the business? Will taking debt for investment in business affect its value? Or I can say if there are two exact same companies, wherein there are two exactly same companies wherein both the companies are having same operations. So the business is same, their level of operations, their type of customers, the macroeconomic risk that they are facing, everything is same. So in essence, we say that both the companies are having same level of earnings before interest and tax. So if that is the situation, and I'm saying that both the companies are different only in regards to their capital structure, in which we say one of them is having equity in its capital structure and the other is having equity as well as debt. Or I can say one of the companies is levered, the other company is totally unlevered. Then in that case, will the value of both the companies be same, or is it going to be different? Will the value of both companies is going to be same, or is it going to be different? So now the point over here is there are two different set of economists who are saying that some of them say that yes, they are going to be different. Some of them say no, they are not going to be. So you can say there are one category of investors, one category of financial economists, which they say are yes, they are going to be different. There is another category of economists which say no, they are not going to be different. So answer is like yes and no. So if the economists who say yes, they are said to be following theory of, or I can say they are following theories of relevance. Theories of relevance, and the other is theories of irrelevance. Theories of relevance means they say that capital structure is relevant or capital structure is important to determine the value of a company. And the other set of theories say no, the capital structure is not important, right? So theories of relevance means they say value, wherein they say that value of company will differ as per capital structure. Whereas in case of theories of irrelevance, we say value of company will not differ as per capital structure. Okay, so there are two set of financial economics. So some of the theories of relevance which we are going to observe, one of them is, of course, they are not seeing it out of thin air, out of without any reasoning. All of them are trying to prove their point with their own justification, with their own point of view. So theories of relevance, we have got certain theories. One is uh, net income approach. Okay, one is a net income approach. Second is net operating income approach. And third is, sorry, my bad, not net operating income. Uh, Counter the net income approach, then we had a theory of irrelevance, which was net operating income approach. Then again, there was some problem in net operating income approach. So we had another theory coming in, which was a traditional theory. Theories of irrelevance, again, we have got, there is another theory coming in which says that capital structure is going to remain same, whatever be the amount of debt you take. So that's your Modigliani Miller approach. And we have also the same Modigliani Miller approach, but that becomes a theory of relevance if tax is applicable. If we have tax applicable, then the same Modigliani Miller approach, it becomes a theory of relevance. Originally, it's a theory of irrelevance, but when tax comes into picture, the approach becomes a theory of relevance. Okay. So let's understand each of these theories one by one. By the way, this is our Modigliani Miller arbitrage. Okay. Modigliani Miller arbitrage approach. So approach, if tax is applicable, is something that goes into the theories of relevance. Now let's take up one by one. First approach that we are looking at is net income approach. Now there are certain assumptions that we need to place before we go for any of these theories. Because the beauty is, whenever we are talking of theories, all economics are based on certain assumptions. The theories are going to be based on within the walls of the assumption, and the beauty is appreciating the theory subject to those uh, assumptions. So some of the assumptions that we have, some of the assumptions that we are going to take in case of this capital structure is, first, there are only no assumption is that two kinds of funds, which is debt and equity. So there are only two kinds of funds. We can either employ debt or equity. We don't have anything called as preference shares in our. Okay. Uh, Second assumption that we have is, yeah. Second assumption is no taxes. Again, as we say, we remove that assumption of taxes, then there are certain changes that we're going to observe. Third assumption that we say is 100% dividend payout. It means we are assuming whatever the company is earning, the company is going to pay out the entire amount of dividend. Company is not going to retain anything. Apart from that, we say business risk is same throughout. So in future, there is no change in the business risk that's happening. The other assumption that is the firm has perpetual life, which is very much accepted assumption in our accounting world also, right? So say the firm has perpetual life, and say the pattern of financing is constant. So there's no change in pattern of financing. If there is a debt and equity, that's going to be there till perpetuity. If you're assuming that it's fully equity, then it's going to be fully equity till perpetuity. These are certain assumptions. Now let's go for the net income approach. Now, again, before we go to the net income approach, we need to look at what do we mean by value, uh, function of value. Simple formula that we need to remember: value of equity is going to be profit after tax divided by K. Profit after tax divided by K. Then value of debt. We're going to say that value of debt is interest expense divided by cost of debt. Then the value of firm is going to be EBIT divided by KO. And we also say that value of firm is equal to value of equity plus value of debt. Value of equity is PAT upon K, value of debt is interest upon KD, value of firm is EBIT upon KO, and also it is value of equity plus value of. Okay, so these are the basic formulae that we need to remember before we take up the capital structure discussion. First up, net income approach. Let's talk of net income approach. Net income approach, was it a theory of relevance? Was it a theory of irrelevance? It was a theory of relevance because it stated as you change your capital structure, value is also going to change. As you change your capital structure, value of the company is also going to change. So, what is the basis on which they are stating this? Let's understand that. First point that they say is cost of debt is less than cost of equity. You guys agree with that? Cost of debt is less than cost of equity. Are we agreeing with it that the cost of debt is less than cost of equity? Is it true? Of course, yes, it is correct, sir. Cost of debt is definitely less than cost of equity because the equity shareholders are taking a higher risk. So of course, they expect a higher rate of return. Venture holders expect a lower rate. The first point is definitely correct. Second point that they say in this theory is as weightage of debt increases, overall cost of capital decreases. They say as the weightage of debt is increasing, overall cost of capital is decreasing. Right? So let's just try to observe it. Let's say we've got equity, we've got debt, and we can say weight of equity, weight of. So initially the equity is fully 10,000 and debt is zero. Okay, so fully it is funded by equity itself. So we say weight is basically one and weightage of debt is one minus. That's 10,000 divided by sum of 10,000. Weightage of equity and weightage of debt is. Then let's say what is the cost of equity and cost of debt? Cost of debt, cost of equity is say 15% and cost of debt is 10%. So overall cost of capital, weighted average cost of capital, we know it is weight of equity into cost of equity plus weight of debt into cost of that is cost of equity into weight of equity plus cost of debt into weight of debt. Let this as 15%, which is but obvious going to remain 15% because the entire investment is made by way of equity shares. Now, suppose the company says, let us bring some debt into our capital structure. Let us buy back certain equity and bring some debt into our capital structure. What we observe is, uh, let's keep it as 9,000, 1,000 shares are bought back by borrowing 1,000. So you buy back 1,000 worth of shares by borrowing 1,000. You borrow 1,000 and then pay that to your equity shareholders. So equity shareholders value goes down. So now, your weightage of equity is 0.5 and the weightage of debt is be zero point 0.1. Your cost of equity, cost of debt is going to remain same. Just the overall cost of capital to become 14.5. So can we see that as you increase your proportion of debt, overall cost of capital is getting reduced. Overall cost of capital is getting reduced to 14.5. Now let's say you reduce it further by saying that let's keep 7,000 only equity and balance 3,000 as debt. Now, of course, the weightage is 0.7, zero point 0.3, and overall cost of capital is 13.5%. Now, let's go further and make it as maybe 5,000. Still was 5,000. Weightage coming 0.5, zero point 0.5, and the overall cost of capital gets reduced to even 12.5%. If I take like, let's keep just equity 1,000 and debt of 9,000. Cost of capital, it reduces to 10%, 10.5%. What do we observe? As the weightage of debt is kept on increasing, the overall cost of capital is reduced. As the weightage of debt is increasing, or overall cost of capital is also reducing. Okay. So in that situation, since our overall cost of capital is getting reduced, third point that they simply state is as payroll reduces, as your overall cost of capital reduces, value of firm will increase. So How is that going to happen? It's pretty simple. Let us say we're going to consider EBIT levels, earnings before interest and tax levels. So earnings before interest and tax level, let us say it is 2,000. And we have the KO figures. And based on your capital structure, whether you take debt or whether you don't take debt, your EBIT is going to remain constant. EBIT is not going to change, right? So I just need to check the value of the firm. Value of the firm is simply computed as EBIT as rate divided by overall cost of capital, which is K. What we observe as the KO is reduced, value of the firm is increasing because value of the firm is determined as what? Earnings before interest and tax divided by overall cost of capital. So value of the firm is going to increase. What we observe is we started with changing the capital structure. We ended with value of the firm getting increased, right? So what can we conclude from here? We can definitely conclude that changing capital structure is going to change the value of the firm. That's what has been stated in the net income approach. Right? So if I draw a chart over here, if I draw a chart as rate of debt, as the rate of debt keeps on increasing, as the rate of debt keeps on increasing, what happens is your cost of equity is obviously higher. Your cost of debt is on the lower side. But what happens to your overall cost of capital? Keeps on reducing. Our net income. This concept clear, guys? The concept clear for net income approach. Okay. Now, there was a problem, or rather, there is a problem in this approach. It's not a problem, but it's a shortcoming or something which has been, ignored. What has been really ignored or has been considered? In the net income approach, you are assuming that whatever be the amount of debt, your equity shareholders are going to demand same 15%. Is it really true? Is it correct that you can take any amount of debt, you can have any amount of risk in your business, and can have any amount of risk in the business, and you say that the value of the firm is, the cost of equity is going to remain constant and value is also going to increase. That's not true, right? Because as you increase the weightage of debt, as you increase the weightage of debt, what's happening to the cost of equity? Cost of equity is definitely going to rise. Now, why the cost of equity is going to rise? For a simple reason that the cost of equity is going to rise because the risk for equity shareholders is going to increase, right? Okay, so that shortcoming was actually covered, or that shortcoming was rectified in the next approach, which is net operating income. Net operating income. And this net operating income approach, you start with the same set of justification, but it ends with a totally different outcome. So what they are talking. They say that cost of debt is less than cost of equity. And then they say that as weightage of debt increases, KO is going to decrease. They say that it is true that as the weightage of debt increases, KO is going to decrease. But one more thing is going to happen with that. If your weightage of debt is increasing, risk for equity shareholder will increase. As the risk for equity shareholders increases, expected return equity shareholder will also increase, which essentially means that KE will increase. So this, if weightage of debt is increasing, KO will decrease. This for equity shareholders is also going to increase. And the resultant impact, you can say, the resultant impact is that as K increases, as you know, K increases, what is going to be the resultant impact? The resultant impact is that KO will also increase. So the net effect of both the things, which is, weight of debt being increased, one side there will be a downward pressure to reduce the overall KO because your weightage of debt is increasing. But since your K is also rising, the KO will be having an upward pressure also. So I just try to draw a graph over here, your understanding, your weightage of debt. As weightage of debt increases, you know, cost of equity is definitely going to increase. Cost of debt is more or less constant. So now your KO curve, which is the overall cost of capital, that will remain stagnant because K is pulling it upside, KD is pulling it downside. So there's an equal pressure and the KO will become constant. When we want to illustrate it, what we observe is when it was 9,000, was zero point 0.9 and zero point 0.1. So weightage of equity and debt is 0.9, cost of equity is 15 and 10, fine. That's 14.5. However, if you reduce if you're going to take more debt, then the K is not going to be 15%. But as per this model, they say K is going to, increase up to such extent that value of uh, the value of overall cost of capital will remain same. Let's say maybe this becomes 16.5%. Yeah, so it can be like 16.43%, wherein you see that your overall cost of capital will remain same. That's what the theory says, that overall cost of capital will remain same by a corresponding increase in the cost of it. If you're taking it as let's say 50-50, then this one may be this should work out to be like 19%, yeah, 15.5%. And if this is a scenario, then I think it's 5%. Yeah, 55%. KO will become 40. So irrespective of whatever is the weightage of equity and debt, since the K is started rising, your overall cost of capital will remain same. Now, as your overall cost of capital is same, value of the firm is also going to remain same, irrespective of whatever be the interest. That's your net operating income. The only point of difference that we have as compared to net income approach is on overall cost of capital, there is a dual pressure. It is getting pulled down by lower cost of debt, and also simultaneously it is getting pulled up due to higher cost of. Okay, so this is our net operating income. I hope this makes sense to everyone. Be able to take the difference between net income and net operating income. Yes. Okay. So uh, here, net operating income approach we did under an assumption that there is no tax. Under no tax scenario, you say that value of a levered firm is same as value of unlevered firm. This is applicable if no taxes. Whereas value of levered will not be equal to the value of unlevered if you have tax coming in. Value of levered will be value of unlevered plus the amount of debt into tax rate. That will be the addition in the value which we have. Okay. So this is what we say as NOI, net operating income, with taxes, or we can say this is our MM with the taxes. Body millimeter. Okay. So whenever you have tax coming into your picture, value of both the companies are not going to remain. Net operating income approach holds true only if there are no taxes. If you have tax coming in, then NOI with the taxes, you can say it's going to be applicable, in which there is going to be an increase in the value of the firm by debt amount into tax. Why do we have this? Because on debt, you have a tax saving. Whatever is the amount of interest you pay, you get a tax saving on that, right? That tax saving comes as an additional inflow to your equity shareholders that boosts the value of, right? So whenever it is NOI with taxes, you need to remember that it's going to be value of levered will be equal to value of plus debt amount into tax. Now this is again MM with taxes approach. Now there is another approach. It's called as a traditional traditional approach. What happens in this traditional approach? They take a shortcoming that we have in the net operating income approach, and that shortcoming is removed. What's the shortcoming over here? The proponents of the traditional approach, they say if you are taking higher amount of debt, you're taking higher amount of debt, uh, you feel like the cost of debt is also going to remain constant. Is it that cost of debt is also going to remain constant? If you're going to take more amount of debt, cost of debt is also going to remain constant throughout? Of course not. Because higher level of debt also indicates a higher level of risk for the venture holders or for the banks. And due to that, even the cost of debt should rise. They pose the cost of capital curve in a bit different way. In the traditional approach, they say we can divide the amount of borrowings into three different phases. In the first phase, obviously the cost of equity is definitely going to be on the higher side, right? This is your K curve, which is on the higher side, KD, which is on the lower side. Now, this KE and KD, if your KE is higher and if your KD is lower, what is going to be the impact on overall cost of capital? That's going to reduce, right? Overall cost of capital is KD is higher, KD is lower. Capital is on a sliding side. It's going on a getting increased with the proportion of debt, or this is a weightage of. But over here, what we talk of, it's like similar to the net income approach, wherein we say when you take some smaller amount of debt, shareholders are not someone who will immediately start asking for higher. Shareholders will maintain some amount of patience that they will see what is the amount of borrowing that the company is taking. It is within the acceptable range. It is within the acceptable range in which maybe out of total capital 2%, 4%, or 5% is an acceptable amount of debt. For that, we won't be asking for a higher rate of. But if you cross that limit, the equity shareholders will start asking for greater rate of return, and for that, you can say cost of equity will start rising. Now, what will happen if cost of equity is rising? but your cost of debt is constant. Of course, overall cost of capital will also become substantially similar to the net operating profit. There will be dual pressure on the overall cost of capital, in which there will be upward pressure due to T and there will be downward pressure due to the lower cost of debt. After a point of time, even the bankers are not going to be agreeing for lower rate of interest. They're going to borrow like 30, 40, 50%, that's fine. But if it is like crossing 80% of your total funds, then the bankers will also start asking for higher return. And even the KO is going to start. Right? So this is a traditional approach. It's a combination of both the approaches in a sense that it also removes the problem or an error in the property income, where it says that whatever with the amount of debt you borrow, the capital, the cost of debt is going to remain same, which is totally absurd. Right? It's totally absurd that you cannot be expecting banker to be asking you same rate of return as it asks you when you were having no debt. Okay, that's a traditional approach. Then uh, there is something called as Modigliani Miller arbitrage approach. Modigliani Miller arbitrage. Modigliani Miller arbitrage. So what is this arbitrage approach? Have you ever heard of this term arbitrage, guys? Ever heard of the term called as arbitrage? Ever heard this term arbitrage? No, right? Arbitrage is basically what? Uh, Taking advantage of price differences. Like if I ask you, there is, or simply let me take an example. NSE and BSE are the two stock exchanges on which shares of the companies trade. So on NSE, uh, let's say one of the shares is trading at a price of 1200. BSE, it's trading at 1 to 1. You do as a rational investor, what will be your course of action when you're observing this price? What would you do? What would be your course of action when you're observing this price? That at NSE the price is trading at 1200 and in BSE it is trading at 1 to 1. Yeah, what would you do? Of course, you will buy in NSE and you will take the same share and sell it in BSE to get a profit of 15. Basically, you are going to buy in undervalued market and you are going to sell in overvalued. Correct? So you're going to buy in the undervalued market. You're going to sell in the overvalued. Now, something of this sort also happens in case of capital structure. So let us take an example because Modic and Miller were always on the proponent that both the companies are supposed to be having same value. Both the companies are supposed to be having same value. But if you observe that the prices are or the values are not actually same, then are not actually same, then there should be some strategy. Let's say we have got P and Q as companies. Company P is a unlevered company, and company Q is, let's say, it's a levered company. P is a unlevered company, Q is a levered company, and let us say we have got capital as equity share capital and things. So in this company, there's a not starting. Okay. Let's say EBIT is 10,000 into the company's EBIT is 10,000. Let's say company P is paying no debt, but the other company is reverse. It's obviously paying some amount of debt. And suppose the debt is the interest that it is paying is maybe, let's say 3,000. 3,000 or let's take it as 4,000. This is interest at the rate of 16%. And your profit before tax, of course, remaining, we can say that cost of equity is 20% and cost of debt or cost of debt applicable 16% the cost of debt in case of levered entity. Of course, cost of equity for the levered is going to be a bit higher. Let's say it's 23%. So we can say what's the value of X? Value of debt will be interest divided by, so there's no debt over here. But in case of unlevered entity, it's going to be levered, the interest divided by cost of debt, which is 16%. Then we say what's the value of equity? Value of equity, as we have observed, it is profit before tax divided by cost of, and then we take the value of the firm as a total of both of them. So what we observe that which of these two companies are overvalued and which one is undervalued is, tell me which of these two companies are overvalued and which of them are undervalued. Let's say one, two, three, 1%. Which of these two companies is undervalued and which one is overvalued? Of course, the reward entity is having a higher value, and this is going to be a lower value. So, if you want to take advantage, uh, arbitrage action would be, buy the shares of lever of the company P, and you should sell the shares of company Q. Buy the shares of company P, sell the shares of company Q because company Q is overvalued. Whenever there is any overvaluation, we will tend to sell the share. So is there any advantage by selling the share of Q? Let's take an example. Uh, Suppose an investor holds 10% stake in Q. So what is the amount that he's going to receive on selling the shares of Q? Proceeds from sale of shares in Q. Since you are holding 10% stake, whatever is the value of equity, 10% of that is something what you're going to receive. 28, 2,854 as proceeds of company Q shares. But remember, when you were invested this company Q, when you were invested in company Q, when you invested in a company Q, you were actually holding, some amount of indirect risk in your portfolios. How come indirect risk? Your investment of 2857, it was not something, which was not subject to risk of company being at default. There was always a risk of company being at default. So if company defaulted, your money would have been utilized by the company for repayment of the loans. There was an indirect risk on you. Yes, because whenever you and arbitrage, the risk has to be equal. So when you were an investor in the levered entity in the company Q, you had invested 2857, which is 10% of the equity share capital, but you were entitled to 10% of the assets of the company. And for that, the company has taken a loan of 25,000. Proceeds from sale of Q is definitely 2857. But to match this loan to be taken, loan to be taken will be 10% of the loan that we had in the levered entity. So 2,500 loan you are going to take. Earlier, the loan was taken by the bank, loan was taken by the company Q on its own. But here you are going to take loan on your own. So total funds that we are accumulating is 535. Now with these funds, we will say invest this money in P. We're going to invest this in P. So by investing this percentage stake acquired, percentage stake that we are taking is 5357, right? On the total value of 50,000. So of course, our percentage stake is 10.71%. Our percentage stake is 10.71%. Earlier, we were just 10% holder over there, but in this new company, we're going to have a 10.71% stake. So with this 10.71% stake, can you tell me what will be the share in tax? Share in basically profit before tax of P. That will be 10.71% into 10,000, which is 1071. Right? So that's your 1071. Of course, on that, we're also paying interest. Paying interest. Interest will be the loan that we have taken. On that, 15% will be the interest. And we have profit from P. Net profit that we will receive is 71.428. What was the income earlier? What was the income earlier? It was 10% of this profit. Right? It was 10% of the 6,000 profit. Now, due to the arbitrage, due to your investment being shifted from a levered entity to the unlevered entity, to have an increase earnings as 71.4. So definitely it's a positive sign that you should change your earnings or you should change your investment from Q P limited, because by shifting from Q to P, you're getting more income. If that happens, the value of equity shares of Q will take downfall, because people are, investors are shifting from company Q to company P, and company P value is going to go up. So over a period of time, what is going to happen is company P and Q will be valued at par. They are going to be valued at equal levels. Company P and Q are going to value equally, so that earnings are same in both the companies, irrespective of whoever is invested in either of the companies. This is what we have for the money planning method arbitrage approach. Okay, similarly, an investor can also shift from unlevered to levered. Now, with that, we are completing this capital structure discussion. Now, the remaining time, I would like to uh, so take it for discussion of any queries that you guys can unmute yourself, those who are on the Zoom meeting. You can unmute yourself and have a question that you have in your mind. Any question related to this topic, you can ask. You can unmute yourself, raise your hand. I will allow you to unmute yourself and then your question in mind. Any questions, guys? Please raise your hand. I will answer them. Just raise your hands and be allowed to unmute yourself. Any queries that you have, guys? We have covered almost all the concepts, also done quite a few questions. Why is this entire topic of capital structure? Anyone would like to unmute and ask any queries, guys? You have? Yeah, Kiran. Go ahead.
Good evening, sir. Please explain trade-off theory.
Sorry.
Trade-off theory, sir. It is in
Not
the
audible
module.
clear.
Trade-off theory.
Just wait a moment.
Yes.
Yeah, Kiran. Go ahead. You can speak, Kiran.
It's a trade-off theory.
Page of theory.
Trade-off theory. Yes, sir. Trade-off.
Which page of theory you're talking of?
So it is in the module. It is trade-off theory. I'm typing it.
In the module.
Yes, sir.
The module structure. Which page number?
Sir, I have a old module. It is 5.25.
5.25. Can you name the concept?
It is in the capital structure only, sir.
Yeah. In capital structure, 5 point.
25. I have a old module, sir.
That's fine.
Hmm.
Trade-off theory you're talking of.
Yes, sir. Yes, sir.
Okay, okay. Trade-off theory.
Yes, sir.
This one you're talking of.
Yes, sir.
Okay, so trade-off theory, this is a theory of raising capital structure based on practical experience. Okay, based on the practical experience, what they have observed that any fund manager, whenever they want to raise money, the lowest cost of fund is definitely debt, but debt also comes with some sort of risk. Risk is that if you take more and more debt, the company may not be able to fulfill the requirement. Company may not be able to pay the interest. So if the company is not able to pay the interest, it will have to go through the financial distress,
Yes, sir.
right?
Yes, sir.
So as far as ideally whatever net income approach has stated that if you take debt, your overall cost of capital will go down and your value of the company will go up.
Yes, sir.
Tackle that, this trade-off theory says that true to that, your increase in value of the firm will be the upper line which you observe,
Yes, sir.
the upper line that you're observing, the lighter line, right?
Right.
You'll be able to attain higher value with the higher level of debt.
Yes,
But the real value of the company is not going to be that theoretical value which you're talking of, as the value will keep on increasing as you take more and more debt. Because beyond a certain point of time, debt is something which is not which is not sustainable, and the cost of financial distress will actually reduce your value of. So you are supposed to be taking debt only to an optimum level, at which your company value is going to increase. Beyond that, the value is going to fall. It should not go beyond this point. Okay. You have the present value of interest tax shield, which provides you an increase in value. So instead of taking any debt, if you don't take any debt, the value is supposed to be remaining constant, let's say. If you are going to take debt, the value is going to increase due to the benefit of tax savings. So that present value of tax saving is going to add to your value. But there is a background, there is a risk that is running in the back, and that actually reduces the value of the company to a bit extent as compared to what it should be. And beyond the point of that, the additional benefit that you get is maybe start declining because of higher cost of financial instruments. So whenever there is a point of time that company wants to raise money, it will obviously compare both the advantages of debt and also the risk of debt. So there is a trade-off between uh, advantage and the risk that the company goes through when it takes the debt. And that's what this trade-off theory talks of, that company needs to balance these things. Is it clear, Kiran?
Yes, sir.
Oh.
Yes, sir. Thank you, sir.
Any other queries, guys? Any other queries? No? All clear? Perfect. So in that case, let's just stop here for the day, guys. Next class, we'll take up another interesting topic of leverage. And again, we'll be revising the things and doing quite a few questions also. So let's stop here for the day, guys. See you in the next class, guys.
Thank you, sir.
Yeah, thank you. All the best, guys.
Thank you, sir.
In case if you have queries, which you have not asked me today, you can definitely bring it up in the next class also. We will discuss that in the next class also. Okay. Chalo.
Okay.
Bye bye, guys. Good night.
Good day.
Good night.
Recording stopped.